Welcome back to the video. Lots of investors are worried about big tech Capex spend, return on investment, depreciation. In this video, I'm gonna be ranking all big tech stocks, their Capex, risks, and which stocks are very well positioned for post-AI era. By the end of this video, I will give you 3 stocks I believe have significant advantage comparing to others. And also, of course, we're gonna be discussing risks. Starting from the largest company in the world, Nvidia, making most of its money from data center segment, $62 billion per quarter, gaming, almost $4 billion, professional visualization, automotive, they are making contracts with different companies, including Benz, Audi, and they will be building a software. So the main difference between the Tesla's self-driving software and Nvidia's is that Tesla has real cars on the road, and these cars are driving and collecting more data, and this data is used to improve the software. Meanwhile, Nvidia is just using their chips and building software to generate those kind of cases and trying to learn from these cases from the software. So they are trying to do this way. I believe Tesla has advantage with their model because they have more edge cases, real world edge cases. But anyhow, currently for Nvidia is just $600 million segment per quarter. So this is not really moving the needle for the company itself. The margins for Nvidia is absolutely mind-blowing. Gross margins of 70%, net income margins of 50%, free cash flow margins of 45%. All revenue, income, and free cash flow just exploded in 2023 and continued exploding, and Nvidia is projection another revenue growth of almost 60%. Margins continue to expand. Nvidia has a lot of pricing power. Free cash flow, can you see this kind of explosion in free cash flow? Absolutely mind-blowing. And a huge growth in free cash flow leading to increase in buybacks. You can see the buybacks are already reaching $40 billion per year for Nvidia. Meanwhile, dividends are not really growing because Nvidia is not focusing on paying dividends to the shareholders. The cash pile is growing, the debt is not growing. Very healthy company. The buyback yield here is reaching just 1% because the company is $4.5 trillion. EPS, earnings per share, free cash flow per share, revenue per share, all up to the right. Absolutely beautiful. From the valuation perspective, Nvidia is quite cheap based on the projected revenue growth. But the worry and why investors are not confident buying Nvidia here is because they are afraid of cyclicality of this business, because all the semiconductor companies, they are cyclical. So that's why Nvidia is traded at price to earnings of 35. Price to sales for Nvidia is 19, which is close to medium, but I would not value Nvidia based on price to sales because they are really optimized for free cash flow. They are already optimized for earnings, so I would prefer to value them for based on the price to free cash flow and also price to earnings, and I would avoid value them on price to sales. Now from the perspective of price to free cash flow is 43, but the growth for this company is quite amazing. So I believe Nvidia is quite cheap here. But again, the main risk is cyclicality of the business. Coming to the second company, Microsoft. Microsoft is a very diversified company with a huge moat. They have 3 main business segments: productivity and business processes. This includes Office 365, LinkedIn, business software. The second segment is intelligent cloud. This includes Azure cloud computing and enterprise infrastructure. And the third segment is more personal computing, includes Windows licenses, Xbox gaming, Surface devices, and Bing advertising. You can see the diversification between these segments. Microsoft is a very profitable company. You can see gross profit out of $81 billion in revenue, 55 billion coming to the gross profit, and finally almost 40 billion coming to the net income. So this is very, very profitable business with free cash flow margin of 25%, net income margin north of 40%, and gross margins coming to 70%. The growth is also quite good here for both bottom line and top line. Very stable company, growing up to the right profitability, margins are stable, huge moat. In terms of the price of the stock, you can see Microsoft has some kind of correction recently, and if we pay a look at the drawdown, currently Microsoft has almost 30% drawdown. We are reaching the levels of 2023 bear market. which is quite delicious prices for Microsoft, I would say. Meanwhile, if we are looking at the valuation for the last 10 years, the medium is a 33 for price to earnings, and currently we are trading less than 24. So I believe this is quite good opportunity to grab some shares of Microsoft at these prices. Meanwhile, Microsoft, of course, is investing a lot into the Capex. That's why we should not value Microsoft at price to free cash flow, but we should pay attention to price to operating cash flow. And here we have similar picture. In here, the correction leading to price to operating cash flow of around 21, 22, and now Microsoft is trading at 17, which is cheaper than 2022 bear market. So I would say, based on these valuation metrics, if you believe that Microsoft sold off from their software sell-off and not correctly, if you believe in the mode of Microsoft is quite a good buy here, at least dollar cost averaging into the company. This company is really a juggernaut of the company. In terms of the risks for Microsoft, currently they own a huge portion of OpenAI. So if you believe that there could be something wrong with OpenAI going public, or with OpenAI doing something wrong, or whatever, there is some risk here. But I believe in the worst case scenario, Microsoft will just purchase OpenAI cheaper than it was in reality, or some stuff like that. So I'm not really too much worried about this. I think Microsoft has a huge moat. They have a software, so they are not pure software company. They have software, they have hardware, they are really deep into the enterprise. So I cannot really see businesses are switching very fast from the Microsoft software. They own Windows, they are second largest cloud. Based on that, I think Microsoft will be doing well. Will Microsoft correct more? Probably yes, together with the market, because now we are kind of like a crashing, and from a technical perspective broke some support levels and stuff. And also the war in Iran is not really giving too much confidence to investors. And now investors started to price in rate hikes instead of rate cuts. So everything could happen from the macroeconomic perspective. But as a long-term investment, Microsoft fundamentally is very solid here. The next company is Apple. Apple is quite controversial. Some people say that Apple is the strongest moat company in the world. Some people say that Apple are not innovative enough. I was in a camp of saying Apple was not innovating enough recently, but I have to tell you, I believe that in a post-AI era, Apple could be playing very significant role. Let me explain why. So currently the revenue segments for Apple are the next. iPhone, $85 billion, services, high margin business, $30 billion, variables, home and accessories, $12 billion, iPad, $8 billion, and Mac, $8.39 billion. Let me explain why I believe Apple could be well positioned for the post-AI era. Currently, the AI mostly is running in the clouds. So when we are doing some prompts, or we are asking to generate some picture, or we are asking for some agentic task, probably this request is going to the cloud, being processed in the cloud, which is AWS, Google Cloud, or Microsoft Azure. But in the future, with the improvement of the hardware, there will be more and more use cases where the customers would love to do AI on the device, not sending the data to the cloud, but doing on the device secure AI. And for this, Apple currently are the best position, because Microsoft devices are not as strong from the hardware perspective, and Mac devices, Mac Pro, MacBook Pro, Mac Mini, and so on and so forth, those kind of devices with the new M chips, they are running AI. They have a lot of memory, and they can efficiently run all those models on prime on the device. So I believe in the future this Mac segment could be significantly growing more. And also, of course, with the improvement of the hardware, the AI models will be running in the iPhone, in your iPhone as well. That's why I think Apple is quite well positioned. But let us continue to having a look at the Apple. Currently, you can see from 2021 the revenue is quite flat. The net income and free cash flow is also, there is not too much growth here. The gross margin is expanding due to the services business. Meanwhile, other margins are stable. The free cash flow is declining after 2022. We could not beat the 2022 record for the free cash flow. most of the free cash flow is going to buybacks. You can see the green line is a free cash flow. Meanwhile, buybacks are reaching almost $100 billion for Apple. Absolutely mind-blowing. The amount of cash is actually not too much. The cash was declining from 2019 and the debt was increasing, which means that Apple is using the debt to buy back stock, which probably is not the best idea for long term. From the perspective of valuation, if we value Apple at price to earnings, I would not say that Apple is too cheap. You can see the 10 years medium is 25. If we try to value from, let's say, 2020, where the services was taking bigger part of Apple's revenue, it's kind of trading at medium. I would say 31 is quite expensive for Apple, but as I mentioned, I believe that Apple is quite good positioned for the future. So that's why probably investors partially agree with my point. That's why giving Apple a premium. Coming to the next company, Google, from the perspective of revenue segments, the biggest revenue segment for Google is, of course, Google Search and other revenue, $63 billion. Then we have Google Cloud revenue, which is growing mind-blowingly fast and outperforming, of course, from the smaller base, but Google Cloud growth is faster than Microsoft Azure and also AWS. So here, the margins are expanding, the growth are quite good. Google subscriptions, platforms, and devices. Here we have a Pixel, devices, different kind of subscription services, recurring revenue, YouTube ads, $11 billion. Google network revenue is slowly declining and currently taking less than $8 billion and other bets here. Google is also a very profitable company, even though they are reinvesting into the business, still coming to the bottom line, $34 billion. Good margins, net income margin north of 30%, free cash flow margin is declining due to huge Capex investment, but still 18%. You can see the revenue is growing, free cash flow is growing, net income is growing, margins are expanding, all the margins except of free cash flow margin. And the reason free cash flow margin is declining is because Capex continue to increase. So we could make a point that Google's free cash flow will go negative. Probably not, because they are generating too much free cash flow. But you can see there is a trend for declining free cash flow. Free cash flow is very solid, 70 billion per year. This is just mind-blowing numbers. Stock buybacks are decreasing. The main reason of decrease in stock buybacks is because they want to buy more chips, reinvest into the business, and try to accelerate the growth. From the perspective of valuation, Google, of course, did some re-rating here. The valuation was of PE 16, absolutely dirt cheap. And then Google jumped to 30, which is basically double, and now have some correction to 27. I believe that Google are fairly priced here. Google is really well positioned. They have a cloud, very fast growing cloud business, good margins. The search business seems like only having tailwinds from AI and not being disrupted of ChatGPT. The Gemini is increasing the DAU, MAU, and probably taking a little bit of market share from the OpenAI and ChatGPT. So I believe Google is doing quite good job here. The price to free cash flow, I would ignore. Price to free cash flow of 50. This is just because they are investing into Capex too much money. That's why if we pay attention to price to operating cash flow, here the picture is a little bit better, but a little bit overpriced based on the historical valuation for Google. The next company is the biggest cloud provider in the world. Online stores, here you have products Amazon directly sells on its website. Third-party services, here you have fees Amazon charges sellers for using its marketplace and logistics. AWS is the biggest cloud provider in the world so far. The Azure is catching up, but currently AWS is printing $35 billion in a quarter. Subscription services, $21 billion. Prime membership is here, and also different digital subscriptions. Advertising services, here you have ads. Amazon charges sellers if they want to show their product in the first place, second place, basically the first row of the products in Amazon.com, those kind of stuff, those kind of ads. So you can basically combine these ad services and online stores. These are working together in a combination. And that's why the margins for Amazon continue going up, because advertising services is very high margin. Meanwhile, online store, of course, is a lower margin business. You have also physical stores and other segment. Amazon was always reinvesting most of its profit. That's why you can see the operating expenses, and after all the expenses, only $21 billion left for Amazon for the net income. But Amazon is growing quite fast. Here is the trend for the revenue, for the net income and free cash flow. Amazon is not optimized too much, but we can see from the perspective of growth and operating margins, Amazon was doing a really good job. Gross margins improved from 37% to now north of 50%, and operating margin improved from 2%, just 2%, to almost 14%. And I believe this will continue because robotics, AI, and efficiency improvement will help Amazon to reduce amount of workforce, to improve the efficiency, to improve the speed. Finally, the margins will continue going up. Amazon is just starting here. From the perspective of valuation, I would prefer to value Amazon based on the price to operating cash flow. And based on the price to operating cash flow, Amazon is dirt cheap here. And I'm not kidding. Amazon is dirt cheap here. Price to operating cash flow of 16. This is basically the cheapest it was in the last 10 years. In the last 10 years. I don't know what to say. Amazon is my largest position, so I'm putting my money where my mouth is. I believe Amazon is a significant opportunity in this market. Meta Platforms is quite interesting company from the perspective that they are not really hyperscaler, but they are spending significant amount of money on capital expenditures, and I will show you the chart of all these companies and their spend on Capex later on. Currently, most of the money Meta is making from family of apps, $59 billion. Here you have WhatsApp, Instagram, Facebook, and of course Reality Labs. Here you have VR, AR, their Quest devices and stuff. Meta is a very profitable company. From $60 billion in revenue, $22 billion is going to the bottom line. Net margin 30%, gross margin 82%. This is what advertising juggernaut is. Free cash flow margin 23%, but again, free cash flow margin will continue to decrease due to the Capex investment. The revenue is growing nicely, net income growing nicely, free cash flow, just beautiful chart. All the margins are stable, very profitable business here we have with Meta. Free cash flow, it mostly was spent on stock buybacks. Again, I believe the stock buybacks will reduce, maybe even dividends will reduce, because currently they need to spend as much money as possible to continue growing the business and to continue building the data centers. For Meta, this is very interesting. As I mentioned, they are not hyperscaler. They are not selling the cloud. They do not have a segment as a cloud, but they have a lot of computing, and they need this computing to train their models to generate a better content for the better AI generated content for their services, Facebook, Instagram, Reels, and so on. And we can already see, based on the projection on the revenue and profitability, that Meta is really getting return on investment from this Capex. I believe Meta is quite well positioned for the post-AI world, because the amount of people coming to the Meta's platforms applications every single day is just mind-blowing. It's more than 3 billion people is coming to the applications every day and using their apps. So after they create some product, they can easily cross-sell. For example, like they did with Threads, they just include the link to Instagram, and finally Threads are already 600 million daily active users. So this is just quite amazing how you can cross-sell, and Zach really knows how to cross-sell their different businesses in the Meta platforms. So I believe Meta is really well positioned. Here is Capex spent for 3 hyperscalers, and Meta, which is not hyperscaler but spending significant amount of money on Capex, $93 billion in 2020, coming to almost 360 billion in 2025. And in 2026, the guidance from this company suggests even bigger jump. Amazon guided for $200 billion, Google guided for $180 billion, Microsoft 120, Meta 120. That's in total $620 billion, which is doubling from 2025. So I think the concern from Wall Street is very valid. It's like, when the Capex grows, this kind of doubling year over year will stop, or when you will show significant return on investment. But I think executives see so large opportunity that they do not really care about the Wall Street concern or about the stock going down. They just see that AI could be one of the biggest opportunity in their lifetime. And as Mark Zuckerberg shared in one of the interview, it has more risk to invest not enough than overinvest. Now, my personal opinion, which I believe is the best position for post-AI era. As I mentioned, I believe Apple is quite well positioned because they will be running AI on device. AI on Macs and also AI on iPhones, and probably they will come up with some more devices which will be related to Internet of Things, maybe smart glasses or stuff like that. So I believe Apple is quite well positioned here, and they do not have a risks for the Capex because they are not really spending Capex too much. They are just using Gemini in their phone. The second one I believe is Google. Why? It's already clear as a day they are taking market share, and in the case if something goes wrong with OpenAI, Google has money to fund this their closed model. Meanwhile, OpenAI are losing lots of money, so they cannot really compete fairly with Google. And a third company I believe will win is Meta Platforms, is because Meta Platforms has a huge distribution, and when you combine huge amount of proprietary data from your users with the LLM, because everybody knows LLM is just a commodity now. So but when you combine a good LLM with a lot of proprietary data inside your business, then you can get a lot of value creation for shareholders. So I believe Apple, Meta, and Google are really well positioned, and they have a little bit less risk comparing to other companies. That's all for today. If you are interested in the tool used to record this video, this is Investkit. I will leave a link in the description below. Absolutely for free. Participate the beta test of this beautiful tool. Thank you so much for watching, and I will see you in the next one.